Good morning and welcome to the latest in the series of Flexible Space Association Workspace Wisdom Webinars. I'm Jane Sarton, Executive Director of FlexSA, and we're joined for today's webinar by Matthew Blair of Flexit MB Consulting, and he's going to talk about top tips for flex operators in expanding and exploring new markets. So in a moment, I'm going to hand over to Matt, who's got some slides to run through. There's a section on your screen to put any questions into. Do put these in as we go along, but we'll wait until the end of the presentation, and then Matt will pick them up afterwards. But do add anything as you're going through, and also at the end of the presentation as well. So I shall get the presentation up on screen, and over to you, Matt.
Thank you very much for the introduction. So, top tips for operators expanding and exploring new markets. It's probably something that all of you are all considering or currently are doing or are in the process of signing off. So my goal this morning is to give you a broad insight into the areas to consider when approaching and planning for these expansion opportunities. I'm going to be covering off 9 sort of areas really through this morning. I'll give you a little bit of an introduction to Flexit MB Consulting. Who am I, and why am I talking to you today? Going to look at why flex is booming. There's probably no shocks it is, but it'd be great to understand a little bit about why. Market overview, some stats from leading agencies. Growth strategies, looking at the models and the risks associated to those models, and the pillars that you need for growth when considering those models. Brand differentiation, that word always catches me out. Thinking brand before property opportunity, a key thing to remember. Investment strategies, some research and marketing, specifically focusing around brand. And at the end, I'll summarize with some key takeaways from the session. So I think if you look at my picture, there's a lot of tapes. Those represent the business centre race for space. Hopefully today we'll put you in that yellow position. So a little bit about me very briefly. Today is about growth, not about MBS. But Flexit as a business, I've been in the flex sector for 12 years, working across different platforms, from brands to supporting brand lords and landlords and operators, but also working as a director for a large brand, which most of you will know of. It is IWG, and that's where I started my journey in Flex. I looked after 20 business centres, which was around 7,000 workstations at the time, with a turnover responsibility of 35 million. I've been consulting since about 2015. I've also operated my own business brokerage and recruitment company. Through those difficult times in the pandemic, I decided to switch from those models to a pure consulting model, which is what I do now. And I advise primarily landlords and operators on growing their businesses, looking at their margins, looking at ROI, and looking at opportunities. I've looked at space planning and concept and design models, financial modelling to mitigate risk, but also improve profit performance. And I also dispose myself of fully managed spaces for landlords who aren't quite ready to move into flex, but have got some leasehold stock they want to get some traction with. So that's a little bit about me. If you're interested in finding out more, of course, you can contact me directly. So why is there a flex boom? There's obviously in the last 10, 15 years or so been a rapid evolution that's primarily been driven by the changes in client demand. Not only the fact that clients now accept the serviced office that was often a challenge in previous years, they're now driving a movement towards high, rich amenity centres, and they're looking for better workplace experiences. COVID has really boosted that part of this demand. If we look at London as an obvious model in the UK, there are now over 60 different flex brands that would sit within the London market. So therefore, competition and growth are clearly two elements within that piece of information. So what are the opportunities? There are ample opportunities to grow, and different models will allow you to do this. Clients are increasingly demanding a more hybrid working alternative to the traditional lease. I think we've all seen that and we've all read about it. Operators are expanding into these new markets, but they're exploding more strongly in the key market cities such as London, Manchester, Leeds, Birmingham. But demand in the work near home locations and the suburb towns is also really starting to gain momentum, which is really interesting to see. And it's probably something a lot of you on this webinar are wanting to exploit and to use as part of your growth strategy. Many of the clients that we're experiencing are seeing a demand for the amenity, which I've spoke about, but also the credentials for the green credential of your building. So the impact it has on the environment, but also what they can put on their company that says that they are a green business. So the demand also around employee well-being has also contributed to the way in which supply and demand has been shaped. So as a caveat to thinking about greener buildings is think initially about what your building profile looks like now and what it may look like in the future, because that will affect your investment strategy. And the flex evolution has really been supported by the involvement of technology. So larger occupiers are really demanding innovative booking technology and management software that allow them to create better employee experiences, but also monetize their space in better ways. Okay, so I want to look at some data, and I've chose a couple of key stats from some market leading data brands such as Workday and Instant Offices. There are a lot of data opportunities available for you to look at to understand the market in more detail. But I've chosen just a couple of highlights here to start this conversation around growth. So demand is obviously been driven a lot by supply as well as demand for flexible space. So despite the fact Workday inquiries have increased by 206%, I always think it's worth caveating that obviously supply has grown and the market has changed. So although that sounds extremely encouraging, which it is, there's obviously always caveats with all these statistics. Some of the really important takeaways here is around the demand for larger space. The larger space demand has really been grown through the way in which consumers and occupiers aren't looking to lease the way they used to. So demand for larger enterprise suites has really started to rocket, and we've seen a lot of businesses focusing solely on enterprise business. And if you look at average contract length, 15, 16 months, it's a real shift in the way in which the mentality's changed for consumers and the way they see flex space fitting into their business portfolio. And having longer stay allows you to plan much more rigorous financial strategies when it comes to growing and retaining customers. So rate per desk. This is some really interesting information around the rate per desk, primarily speaking in London, reaching over £800, which is up year on year. Obviously driven by the need for prime space. So the fight for quality in grade A is evident here. And across the regions, there has been an increase in desk pricing. The statistics say £380 or so, and it's marginally up on last year. But I suppose the caveat with that is there is caution in the regions when it comes to growth, because desk rates can be as low as £200 and upwards of £450 to £500. So you'd have to be very conscious around what you do with market research to make sure you create the right plan and don't assume an average market price of £279. But yeah, so average price desk across the UK, £614, very encouraging. Okay, so operator demand. So there is strong demand for management agreements. That's something which I come across regularly in my work. The management agreement has almost replaced the leading choice for operators when it comes to partnering or expanding. UK occupancy reports from instant offices put the UK occupancy at around 80% for business centres. The statistics also show that 39% of those buildings are 90% occupied, mostly in prime locations. So there will be a lower occupancy rate in lower grade buildings. And the city centres are typically faring in occupancy terms at about 10% better than the outskirts. This will inevitably balance out, I believe, once the work from home movement gains stronger momentum and people see the rewards that can be gained from investing in the regions. With regards to the management agreement, just a caveat, I mean, there is a risk that landlords are taking that operators don't necessarily take. And I think that's one of the reasons why that percentage of management agreements has grown, in that there are a great deal of landlords with high void rates that are adopting management agreements where they front all the cash and operate a fixed fee management fee basis with a high profit return shared to the landlord, or an ERV as it's called, an estimated rental value. So I think that has had some impact on why management agreements have shown such a strong uptake in recent years. Okay. So the need to differentiate covers three primary aspects when it comes to growth. You've got your location choices. You need to really identify desirable markets that really fit the amenity need and brand that you're creating, rather than selecting a location purely based on a building deal. A good rent deal, of course, isn't always a primary driver for growth, although I can see it can be quite attractive. Pricing strategy. There is a lot of ways in which you can enter a new market. Do you undercut? Do you compete? Or do you raise the bar, which we've started seeing with some brands that are going into new markets and saying 200 to 300 is the price in this market. We've done our research. We've done our homework. We're going to raise the bar. We're going to drive the level of workstation price and therefore the ROI, which would intrinsically link back to the deal in which they would have structured with a landlord, either through co-invest or a management agreement. And then brand identity. What do you stand for, and will customers relate to your offering, especially in a new market? It may be easier to enter a market without a lot of competition, but you really need to understand the market you're entering so that the market will connect to what you're trying to create in terms of community, areas to collaborate, and places to do business. So do your research and satisfy your brand requirements before thinking about growth. Okay, so growth strategies. Which models should you operate? There are three boxes which I've put together here, focusing on traditional leasing models, the co-invest partnership model, which is becoming the most popular model, and then another one to consider is dedicated managed space, which I'll come on to and explain a bit more in a moment. So the leasing model, straightforward, the most simple traditional model. You take a lease for 10, 15 years, full repair, insure lease. Typically, it's been on an SPV lease model, which gives you an opportunity to de-risk your centralized business by putting the liability into a single business center model. It's the most common model being used, as it very much limits the operator's liability and exposure in the case of financial failure, albeit you are required to have full capital risk when you take out a lease. The co-invest and partnership models. So these are rapidly becoming the best, or most popular, shall I say, choices in the market. For the operator, you've got less risk. There's guaranteed platform fees that can be generated from day one on a monthly basis, typically between £4, £5 or £6 or more £1,000 per calendar month. And there will be an option to share profit once you've met a notional rent level for the landlord, in which the landlord has achieved the rental desirement. Then there'll be a profit share based on a lot of different algorithms and methods which are individually created by each partnership model. The downside with partnership models is there are less profit returns compared to an SPV lease, but obviously the upside is less risk. With the co-invest model, which I've seen some real traction in the market, is that where you don't want to necessarily take the full capital risk of an SPV lease, but you see greater returns by co-investing. Co-investing, I mean, in the FF&E, the furniture, fixtures, fittings, and the Cat B, that would therefore generate higher profit for a marginal, maybe 10-20% investment versus 100% investment on a lease. So there are some sort of pros and cons of both those models, and they will require a level of investigation from your behalf, but also some buy-in from the landlord's perspective if there's a significant investment opportunity required to take a building from where it is to where it needs to be. And this is another option if you're looking to expand simply and quickly, is taking dedicated managed space for your clients. There is the ability for you to take a low risk opportunity here that can be done in your existing building stack. That maybe you are occupying 2 floors and there could be some smaller suites available in the building, and you have a client that's looking to leave you due to expansion. You may be able to require a management agreement on matched terms, say 3 years, 3-year term, matched with the client expectation, and deliver it as a separate entity to your fixed co-working business and offer it on a managed space. The covenants can also be backed by the client if they've strong covenant, to save you having to financially back the requirements of the lease. So that's another one to look for. Okay. So the models, I think I've put something which shocks a lot of people, is that just over 50% of flex businesses appear currently to be profitable. That doesn't necessarily mean that mature businesses aren't profitable. It just means that as a set of statistics across the market, a number of businesses throughout their growth stage may not yet be profitable, or may not be able to be profitable if the rate in the market and their rental deal doesn't stack up. Which comes back to setting realistic occupancy and yield break-even points and being really rigorous around your planning. I think WeWork's the perfect example of not having a clear vision on profit and more of a vision on long-term growth, market grab, but not having a real thought process on contingency of risk in downturns or the inability to meet their budgets. Knowing which model really suits you best is key. Management agreements, we know, are growing in popularity, but you need to keep a clear focus on profitability, balance of risk versus reward, and if you've got investors, what their investor strategy requirement is if they're looking at this as a return on investment model. The enterprise and account models, well, I talked about that a moment ago. That's where you take a specific piece of space, either off market or through your current building stack, where you can support the growth of your exiting client and keep them within your business. The square footage return profits will be locked because they're intrinsically linked within the deal, which gives you a lot of clarity around profit margin and zero risk. If you think of people in the market such as kit offices, who are one of the leaders when it comes to management agreements, they tie the management agreement to the covenant of the client, which links intrinsically to the lease. So therefore, they're not liable for the lease, the client is, but they are able to set profit parameters, profit per square foot margins, once they've taken into consideration all of the fixed costs involved in setting up the management agreement. So it's definitely a good one to think of. Okay, so knowing you, setting out your pillars. There's quite a lot of bullets in there, so I'll give you a few seconds to start flicking through the bullets. But essentially, scaling your business relies on you knowing and understanding your brand, and to ensure growth is easier by doing these three principal things. By knowing the key drivers and knowing what your brand needs first, it'll make it much easier to connect property choices and people choices and consumer choices to what you're doing in terms of a growth strategy. I've actually put a link at the bottom there to a company called Spaces to Places, operated by Zoe Ellis-Moore and her team. If you're interested in learning a bit more about brand, you might want to reach out to Zoe or drop onto their website, Spaces to Places, and take their brand quiz to look at how you could supercharge your brand. I think it's a really great way of understanding more about brand. Brand would cover the items that really are the services you offer, your product mix, what makes your identity different to that of your competitors, and how you can make sure you can hone in on that and sometimes adapt it, but also sell it really solidly to market. The property choices you're going to make will come off that brand. Are you a single site or multi-site type business? Do you prefer to be in stacks where you add amenities to buildings? Are there certain amenities that you just have to have for your type of brand? And what about your competitors? What are they doing in your market? Are they in your market? Can you compete? Can you be ahead of the game? Those are some of the things you need to think about with your property choices. And the location requirements. You know, when you have a brand that has certain requirements from your client base, bearing in mind you're going back to brand, what's our brand doing? Who are we delivering for? You then need to think about what is in our market that we need for our clients. How far from HQ resources is my new business center going to be? Can I support what I need to offer to our clients? Do they have the amenities and transport, so on and so forth, that's going to be right for that particular location? So yeah, I mean, in a crowded market, you need to stand out, and with clear identity and brand differences, it'll make it much easier. Health check your business. There's four main areas here to look at. So I've looked at technology, people, investment, and funding. You can do these relatively simply. Technology. Is the technology management system, operating platforms that you have, dynamic enough to consume larger growth and have the management tools and financial rigor to ensure that you can really exploit the best finances through technology growth and its platforms that come through technology? Do you have the right people strategy today for the future? Are your people on board with growth? And do they have capacity and the ability to grow with your business? Investment. How do your stakeholders, funders view growth, and are they on board and do they understand it? Have you set clear objectives around growth, ROIs, and can you meet them? And funding. Do you have the sufficient funds if an opportunity came along tomorrow to grow? If not, have you looked at how you would bankroll that? Have you looked at lease financing as an option to grow? And has your business model planned for such adventures like that to de-risk yourself if you do take a very quick decision to grow in a market that perhaps you hadn't fully explored? And as I said previously, not all flex businesses make money. So, of course, it's really important to make sure you don't make the wrong decision. Okay, research. Research is probably the key. You need to be really rigorous in your research. Your intel gathering, mystery shopping, speaking to the market, speaking to aggregators is really important. You can gather intel from places such as Instant Offices and Workday, which I've mentioned earlier. They do great reports online. You can speak to specific marketing companies to do research for you. And you can also buy data from places like Co-work Intel reports. Mystery shopping, great way to learn about a market or a new market. Get out there, visit the area, or pay a company to do it for you. Meet local agents, attend a local event, go to local groups, find out about the ethos of that market. You can use the broker channel. You've probably got some favorite agents or brokers you already speak to. Talk to them and find out about rates and deals they've done. And you can also talk to aggregators around information they might hold that could be useful to you. Okay, so in conclusion, setting clear financial objectives is really important. This enables you to adapt your strategy to the building and opportunities that are becoming available. It's very useful as well if an agent comes along and pitches you an opportunity, you need time to think about. But if you've got rigorous models in place, you can adapt really quickly. How much ROI do you need on a management agreement? Will you co-invest to increase that ROI, or will you adopt a smaller, easier management fee arrangement for the elements of safety that's involved, but also the secured profits that can be achieved from it? And you will require possibly a separate report and model that supports ROI funding and growth if you're looking to raise funds prior to growing. So you need to look around you when it comes to your environment. It could be easier to grow around you rather than further away from home. Where's your current business going to be in 5 years' time? Maybe think local first. Don't be immediately tempted to take a building that's thrown onto your desk, but because it's a great rental deal, it may be too far away. Looking back at people, you may not have the people immediately available to do that, and you don't want to risk a really profitable business by pulling out people to support growth somewhere else. And talk to people that know your brand and make sure they're aware of your growth strategy and they're on board with what your mission is, and they'll support you with finding the right properties. Understanding your people is key. You need to review the capability of the people you currently have. Do they need to be retrained? Should you outsource? Do you need consultants? Or should you speak to agencies that can support you? And I mentioned it just a moment ago, you've got some great buildings that are cornerstones to your business success, and they'll have some key people that really understand what it is that makes your business tick. Maybe use them to leverage their skills, but don't always take them away from what is already a successful business model just for the sake of growth. And finally, brand. Brand. It is the differentiator in the market. Build your USPs that will ultimately determine your suitable markets, building profiles, and your growth strategy. Know your competitors, maybe take on their learnings, but be aware of what they're doing and what they don't do. Clearly communicate and stick to your company mission. Customers don't just buy desks. They need to be attracted to what it is exactly that you offer, and you're offering something they should want. I'd like to summarize with 8 key takeaways from today's session. So think strategy first. Have a strategy before growth. Financial planning and having robust models, planning good, better, or best for every opportunity is a real key takeaway. Consider all the models against every building opportunity that you come across, and agree the key requirements that your business and brand needs that must fit a building before agreeing to move forward with the negotiation. So again, think brand. Do your research, enlist the support of experts when needed, and grow when the opportunity and time is right. And that concludes the webinar today. I hope you found it enjoyable, and I'm sure it's raised some questions. If you've any questions, now's a great time to ask.
That was great. Thank you, Matt. You packed a lot in there.
I did.
And yes, we've still got a bit of time for questions if anyone would like to add anything to the chat box. But maybe just to kick off, you talked about management agreements becoming more popular. But do you think there's a reluctance from some landlords still to do this? And if so, are there things that operators can do to try and get over those barriers?
Yeah, absolutely. The management agreement, it's certainly extremely popular. It's a very easy tool for growth. And I think that's why it's very successful for business centres to have a management agreement, because there is a clear element of profit from day one. The fear from landlords that I experience is that the models presented to them always look pretty rosy, so they're not always overly enthralled to maybe invest £1 or £2 million into a business management agreement if they're not 100% sure if the returns are right. So having a variety of models, as I spoke about earlier, is really useful if you're approaching a landlord that may fear the level of investment required and may want to look at different options. And if you've got different options, to bring to the table, or even different brands within your management structure that may help convince them to come on board.
Okay, thank you. We've given people a moment to get your details down, so we'll bring us back onto the screen. I think you're happy for us to share your presentation though as well, if
absolutely,
which we can.
Yeah, sure.
We'll certainly send it to people that have attended today. Just maybe a couple more questions. And do you think, you've talked a lot about growth, but do you think there are threats to growth? What do you think those are at the moment, key ones?
From an operator's perspective, the rise of the brandlord or the institutional landlord moving into the market. We've seen Crown Estates, GPE, lots of REITs and trusts really focusing on how they can diversify their product mix, because they're of course seeing a drop in leasing terms and revenues. So they've been creating their own flex products, which have been fantastic. They're highly funded, so they can create superb facilities, and they can monetize them on a long-term perspective, because they can also use that as a leverage to retain their current client base. So I suppose, to answer the question, with the success models being created by brandlords and landlords themselves, it's possible that larger, especially out-of-town landlords, may start thinking about creating their own flex solutions. I don't necessarily think it's an easy job. It's a very skilled thing to create a flex business. But there is a potentiality that might start infringing on management agreements in the future, where landlords may think, I'll do it myself.
Okay. Question that's just come through. In terms of management style agreements, are landlords more responsive outside of London than inside? What concerns do landlords have partnering with a provider?
I think, just to echo that point around concerns with partnering with a provider, if you're a landlord sat on a void of 2 years of empty space, and you're being told the market's flat, and it's very hard to shift the leasehold space, but you're being presented with what looks like an above rental return model, i.e. through a management agreement, it would seem very attractive, albeit the capital risk sits with the landlord. So I think from a landlord's perspective, there's not an immediate rush to think, okay, I need to now invest in my building, purely because this is the only method or route I have to market, which is why I quite like the brands out there that are also willing to talk about co-investment, because if they really believe in the model's success, having some co-investment through fixtures and fittings or Cat B would show the landlord that they're keen to invest, and that might give further confidence. Would you mind just repeating the first part of the question?
Mm-hmm. In terms of management style agreements, are landlords more responsive outside London than inside?
I think they're more responsive outside of London, purely because of the void rates are potentially higher, but the category of void space is lower. Yeah. The race for space in London has grown extremely fast. We talked earlier, 60 different operators in London, race for grade A. I think there's a different, I think the regions are just slightly behind in terms of the pace. So I think the landlords just need to see success models in the work near home model before they will start getting on board more. I think brands that work with local authorities and councils have been able to get into the market quicker, because of course there's an invested interest from local authority to start activating communities, to start helping to influence local business growth. So those models are working quicker. I think it's just where private landlord investment, private cash, it's harder to get the landlord to part with their money.
Yeah. Okay, and a couple of short questions, which I think there could probably be very long answers to, but what range of square foot are you seeing to be the most popular, and what amenities do you now believe are a must?
So the first one was the square foot.
Yes.
Now that's an interesting question, I suppose. To answer the question, there's probably a minimum for most models. Majority, I'm talking 90% of the market, probably say they would like to see 15 to 25,000 square foot, because they need to put in a stack of amenity. There has to be options for majority of brands to offer some sort of collaboration, whether it be paid for or internalized. And then, of course, 70% of the model needs to be fixed desk revenue. So you've got to have the right stack to be able to produce that revenue return. some brands would argue they opt for a larger space, and I think upwards of 35,000 square foot kind of typically caps that out, although there are a few examples of 60,000 square foot in London that's been acquired recently, or ex-WeWork buildings that have come onto the market and been rebranded. And sorry, the second question?
What amenities are a must? It's certainly a growing list of possibilities there, isn't it?
Well, the amenities that are a must, I think I could probably start listing a lot of them, but if you're talking business centre in a city, the obvious big shouts probably come along the lines of showers, bike storage, some sort of well-being. It might not necessarily be a gym. It could be a studio or a space similar to that. Outside space is not what I would call an amenity must, but it's an amenity lovely to have. Breakout space and communal areas. So that's looking really going back into terminology here, density per workstation and linear density. So how much are you giving the clients? I think the amenity must has to balance that off. If you're giving them a great workstation rate, are they getting ample amenity space to break into when they're tightly packed into an office? Or is it the other way around? They've got less amenity but larger workspace. There are lots of others to mention. Bars, local cafes in the area. I mean, the list is endless. Parking, if you're out of town, would be good to have. There are stacks.
Yeah, and that's where the parking bit is sometimes where the edge comes for if you're not in the city centre that people are looking at. I'm always amazed at the number of beautiful roof terraces I'm increasingly seeing. And those
I was thinking roof terraces while I was thinking about gyms and things. Roof terraces, such a great one to have. I mean, they are expensive to add on to a building, but they are a great if you're looking to have a wow factor building or a focal point, or if you want to really drive desk rate.
I think it's Google that's taken it a step further with a running track on their roof as well. So that's
I've seen that.
Right. I think this is probably final question. Is partnering with a provider viewed as a last resort for landlords with empty buildings, or are you starting to see a trend of landlords automatically assigning a proportion of space for flex via either a lease or managed agreement with a provider?
I think that question is quite broad in that the last point around proportioning space for management providers does intrinsically link back to the building or the building stack. Now, by stack, I mean the floors, what's in that building. It could be that a landlord has multiple floors. They have a ground floor. It could be retail space. It could be event space. They might have multiple lease tenants. They may have already have in their own strategy model the need for a flex operator to come in to activate and run amenity for them. So yes, there could be floors that need to be either managed by operators or operated by a flex brand to activate the rest of the building. That's where traditionally leased buildings started to flag when their amenities became amenity poor, because they were just floors and floors of individual companies with a one man, one woman style reception and not a lot else. Flex has come in and changed that. It's been able to operate primarily ground floor operated services. But there may be options whereby if a landlord's not willing to do a co-invest or to do a fitted floor, that management companies such as Kit Offices, MetSpace, there are tons of them out there, Bespoke, might come in and say, we'll take that 6,000 square foot, it matches our tenant requirement, we're going to do a managed agreement for it. But yes, there is a move whereby managed spaces are attractive to landlords because of the control it does give them in terms of the investment opportunity that they're putting into their building, if they've got the right investment funding behind them, because of course a management agreement relies heavily on landlord funding and capex risk.
Thank you very much. Thank you for the presentation and taking all those questions as well. So we will make this recording available afterwards. It'll be on our YouTube channel with the bank of our webinars. So if anyone watching now wants to check back on something, or you want to share it with a colleague, it will be available probably later today. And as I said, we will share Matt's presentation as well. So we started, this was the first in our new series of Workspace Wisdom Webinars, and we're getting going now with a number to come. The next one will be on Tuesday, the 1st of October, when we'll be looking at the impacts and benefits of diversity strategies with our service provider member Cleanology and the Minority Supply Development UK organisation. Booking hasn't opened for that quite yet, but will be very shortly. And then on the 16th of October, we're doing a webinar with WaveNet Connected on understanding and preventing cyber vulnerabilities for flexible workspace operators. And you can book for that now on our website. So thank you very much for joining us today, and do keep a lookout for a programme of both webinars and other events to come over the coming weeks. Thank you, Matt, again, and goodbye.
Thank you.